From Ticker Studios, this is The Founder's Method, presented by Memo Bottle.
Everyone talks about how to start a business. Almost no one talks about how to sell one. So what does it actually take to prepare for the exit?
I'm John Byrt.
And I'm Jesse Leeworthy, and this is The Founder's Method. This is the show where we get into the real story behind how founders build, break, and rebuild businesses.
And today's guest sold his business last year for $500 million. With 200 million revenue and a 10x EBITDA multiple, it was the biggest Australian D2C exit in years. And now he's sharing what the road to exit really looks like. He's the co-founder of Quadlock, Rob Ward.
Hello, Rob. Thanks, guys. Welcome to the show, mate. Thanks for coming. Now, before we dive into the road to exit, it'd be good to talk about a bit of your experience, basically.
Yeah.
So you bootstrapped Quadlock for 8 years with no external funding. How did you manage to do this?
A lot of discipline with the spending. You know, CP and I, we get our hands very dirty. We're in everything. We didn't have that many people early on. So we kept costs low, but we were lucky enough to have a great team, and we did a lot with, I think we did a lot with very little, always looking for ways of doing things scalable, and then being pretty ruthless on the marketing sides and things like that, just always looking for the edge, always trying to find that little bit of extra performance in what we were doing. And then the other thing we were able to do is through making good product, having good brand, having lots of customers come back, and then servicing those customers in different parts of what they were doing.
Yeah.
So keep building that ecosystem bigger. The ecosystem was a big part to it.
Yeah, for sure.
Yeah.
So the exit's been pretty public over the last few years.
Yeah.
And the initial deal with Quadrant 2020, and then the ultimate sale to Toole, 500 million 2024. But there was a few times before that where you almost sold. What did you learn from those experiences?
I think CP and I learned we wasted a lot of time with those conversations early on, and we thought that early on, but I think towards the end we were like, that was all just great practice, great learning, because these are things you only do a couple of times, but they're like the biggest things you do, so you don't get that much practice. So actually having those conversations early on, having a few false starts, that actually helped us, I think, in the hindsight. And then the process of selling looks very different as the company grows. So when we were smaller, we had people try buy us more than once, and it didn't work out. Luckily, effectively, we walked away from one very close one, and it was the right call. And then as you grow, you realize, the buying pool actually starts to shrink a bit. Not that many companies can afford you. And then as you're growing, maybe IPO, what does it look like? You realize, okay, we probably don't have the governance, probably don't have what a business of that scale may need to have, because you end up there pretty quick. And even though it feels like a long time, it goes quick when you're on the ride. It does go quick, and you're playing catch up all the time. And when you're playing that catch up, you're not necessarily dotting all your I's, crossing all your T's. So that's where, say to someone like a Quadrant bringing in PE, we didn't need, we felt we knew how to grow the business. We didn't need capital to grow the business, but we needed to bring in those, the bigger business frameworks that a potential next buyer would need, and that was probably what we needed the most at that time.
Okay, so you didn't necessarily need the cash injection when you sold that stake. It was more about getting ready for a potential sale in the future.
If I'm honest, part of it was CP and I de-risking a bit, taking some chips off the table. We were fully in for a long time at that point in time. And I mean, that's a good point. When you go on these ventures, often you leave jobs or you leave well-paying careers to go and have not a well-paying career for a long time. So you have a family coming along, those kind of things. I actually did that deal. Part of it, I was during lockdown in the hospital with my second child being born, so that was a very interesting time. But yeah, so there's multiples of reasons why you do those deals.
Yeah.
And do you think it should always be a goal of a founder to exit?
I think it depends. Like for us, we would always say things like we want to make something bigger than ourselves. And we always thought that would be a potential outcome.
Yeah.
But I think every business is different and every founder is different. Some people just want to run it forever. Some people want to hand it down to their kids, have it a family business. So I think all of those options are very credible. But I think it does, thinking about an exit early, even if it's not the option, it means you have your ducks in a row. So if you think an IPO could be, you want 3 years of audited books. You just want to start getting those governance frameworks in earlier than you need them, I suppose is the thing. Because then you've got options.
Yeah.
You don't have to do it, but you've got options.
Yeah.
Okay, so if a founder is considering one day exiting their business, what are the types of exits that they could do?
Well, the main types of exits, one is a trade sale, so selling to someone from your industry, maybe a bigger player that wants to tuck you in. You can sell to private equity, like what we did. And that may be, you can do these whole or partial, but often it's partial at the start. And then the obvious one is an IPO. Yeah. But you've got to realize, once you sell to someone like a private equity, then there's another event. That's just on the cards.
The clock's ticking.
And, the clock's ticking. And you've got to go into that with your eyes open.
Yeah.
And if you go into that with your eyes open, and I think if you go into that with a clear path forward, not we're going to do this and then we're going to go do all these other weird things that we haven't really done before, if it's all on all these potentials. But for us, it was sort of, nothing simple, but it was what we just need to do is professionalize and just do more of what we're doing. The path was reasonably clear to get there. It was we just need to keep doing this thing, and it's going to be valuable for everyone.
And it probably just depends on what sort of founder or what kind of job you want to do in the future as well. Because if you do an IPO, I think your role changes a lot, doesn't it?
It does, and then you got to think for me, I just think what do I like doing every day. And I love working in a business, on a business, thinking about a business, strategizing, making things happen. I love all that. Would I like reporting to, a foreign ownership? Would I like to reporting to the funds, the ASX? That probably isn't the thing I'd want to get up and do. So you got to think, if that's not what you want to do, you got to make moves.
Yeah.
Yeah. I've heard you say build your business as if you're preparing to sell, even if you don't want to, or something along those lines.
Yeah. I mean, I think it puts you. I think options are great.
Yeah.
Because, in hindsight, everything feels neat and tidy.
Yeah.
But when you're going through it, you don't know where you're going to be at what different period. I mean, things go good, things can go bad. You may, get stressed out, burnt out. There's all these different things that could happen, and if you've got the options, you don't have to do any of them, but they're on the table.
Yeah. So you're not preparing to sell. You're not preparing to sell when you need to sell. You're doing it years in advance.
Yeah, I think the other thing is, it's the tricky thing with these things. All these things are so hard to time.
Yeah.
Because even a lot of what you do in business, you're sort of pulling the lever, but you've got this other party on the other side of these big things like a transaction, and if they don't want to play ball, it's not going to happen.
Yeah.
So it can be so hard. And then you've got lots of external factors, where the market's going, all these things out of your control. So just being ready is kind of a nice place to be.
Sure.
And what does that actually look like? Preparing as you build, and then is a different type of preparation for a different type of exit?
Yeah, definitely different. And it depends on the scale of your business. So when you're selling to someone who's into the growth part of the market, like Quadrant we're in their first growth fund, they know they're buying fast-growing, scrappy startup. They still do a heap of DD and all that, but they know what they're getting into. They expect that. EY hasn't done your books for 4 or 5 years. You're not spending that kind of money. It's just not going to look like that. But then when you're, hundreds of millions in revenue, and you're selling to either a listed company or even bigger PE, the expectation changes, and then your readiness has to change.
So what do you think drives, or what does drive the most company value, other than EBITDA multiples?
I'd say brand. I'd say like, you really want to be a brand. You want to still, buyers still want to see some kind of defensible IP.
Yeah.
And you need to, a lot of times you talk to people and like, oh, we're just about to release this thing and then we'll, like, you want to have, the other side of the deal needs upside.
Yeah.
They got to believe they can get in now and there's upside on the table for them. And that happens, that's every stage. So it's not like you want to wring the rag out of everything and then you decide to sell. That's not really how it works. It's like, what's next? Because all that'll happen if there's not much coming, you're not going to get the multiple you really want.
Yeah, for sure. Are there any like red flags that investors look
I think
out
one
for?
CP will tell you this as well. Like we probably wasted a fair bit of time with a company that they had big aspirations. They were American and they were trying to buy us. And then as soon as we sort of visited, and we're like, we're a way better business than this business, and I don't know how they can, and they couldn't afford us.
Yeah.
And we were growing so fast at the time, and we ended up walking away from it. It was good learning, but you wouldn't want to, you don't want to spend too much time in that space because it just sucks. Like, you know, when you're small and you only got so much energy, it just sucks up so much energy. Yeah.
And then founder and key person influence is probably that's something that they're going to be looking out for as well, is it?
Totally. Yeah. And especially as the businesses get bigger. Yeah, they want to know that you're not selling off into the sunset.
Valuation methods.
Yeah.
Talk to us a bit about that. I mean, like, there's the obvious ones that everyone hears about, which is generally is e-com is the EBITDA multiples.
Yeah, but still, how do you get to those multiples? It's more an art than a science, I think.
Yeah.
It's often combinations of your growth rate and your profitability. I mean, it wasn't that long ago, profitability didn't even matter. As long as you had a growth rate, people would get on board. But especially in direct-to-consumer product category, I think people realize like you've got to have pretty good metrics baked into the business to be able to scale, because the idea of these fast-growing D2C brands that will at one point turn on profitability, they just doesn't eventuate a lot of the time. So you need those good fundamentals baked into the business. You need a strong brand, and you need, like, the things that I'll look for is like high customer lifetime values and things like that. People coming back.
Guaranteed revenues.
And then that's what will hopefully get your multiple up.
Cool.
Yeah, amazing. Well, thank you so much for coming on the show. Like, a big congratulations to you, CP, and the team for what you built. It's amazing. So,
cheers, guys. Thanks.
Thanks, Rob. Cheers.
You're watching Ticker. The Founders Method is presented by Memo Bottle. For more, visit memobottle.com.